Hi, everybody. Welcome to my course. My name is John F. Mahoney. I'm a CPA. The title for the course is Real Estate Taxes. It's really real estate taxes and accounting because you need to know a little bit of accounting in order to understand the tax ramifications. Uh, so I'm going to teach you a little bit of real estate accounting also. All right. First, I'd like to talk a little about myself, and then we're going to go in and speak about the course. The next thing I'll do is talk about the course itself, and then we'll start. I'm doing this so you have an idea of where I'm coming from, like my background, my experience. I spent the first 10 years working for public accounting firms. Some of them were large or larger. I was in mergers and acquisitions. The accounts were very diversified. Manufacturing companies, retail companies, service companies, etc. In the real estate part of it, I did the books for the Empire State Building when it was the biggest building in the world. That was my baby. This is before the World Trade was built. Okay, so I did that for about 10 years, doing what we nowadays call reviews, audits, reviews, and compilations. Then I left that, and we call it going private. I became a controller and a vice president of finance for a number of companies over the next 10 years or so. And again, I was in mergers and acquisitions while I was doing this. I merged myself out of more than one job, and but I was successful. I mean, that's what I wanted to do, and that's what I did. About 30 years ago, I started my own practice, and I do audits, reviews, compilations. I recently stopped audits. I stopped audits really about, I think, 2 years ago. And you know why? I mean, there's a lot of work goes into it. And I'll be honest with you, I didn't have the time. I like teaching. I've been teaching here at NYU for about a little over 30 years. And I teach this course. I teach financial statement analysis. I teach in the undergraduate, Real Estate Accounting and Taxation. In the graduate division, I also taught for our MS in real estate. Okay. I'd like to talk a little about this course. I got the syllabus in front of me. It's going to be 6 sessions, 6 classes. They're going to run about 2.5 hours each. After you play them, if you have any questions whatsoever, email me. My email address is right on the syllabus. Okay, and and then I would get back to you. My telephone number is there too. But you're probably better off emailing me. Why? Because this way I can sit back, think about what you said, and give you a pretty good answer. As opposed to getting on the cell and maybe not answering you. With 100% clear answers. I believe in clear answers. One should have time to do a little research and formulate what you're going to say. That's my opinion. Okay. Anyway, so the first class, which is this one, is going to be choosing an entity. So I'd like to start off by going into key principles of real estate investing first, and then the choice of an entity, like what would you choose? The second class is going to be acquisition of real estate. There's many ways you can acquire, of course, real estate, and the taxes involved in that. Then the third, I'm also going to go into the passive activity rules, and we'll go into that. It's in the book. It's in my book. The third class is going to be on accounting. just a basic accounting, double entry system, things like that. Financial statements, what to look for, a typical conventional financial income statement and balance sheet versus a real estate company. You'll see a difference. You'll see a difference. The fourth class is depreciation. Why is that important? It's a wonderful deduction. Most you can't, if you're most other investments, you can't write off until you sell. This one here, you write it off every year. You're writing off a piece of the building or a piece of the property. The fifth class is going to be on leases. And of course, a lot of things changed recently. Incidentally, about change, if any new developments occur, okay, in the tax law or accounting for real estate entities, anything like that, I will give you all an email on it, okay? If it's a significant change that's going to take a long time to explain, I'll give you a Zoom. I'll give you a Zoom on it. So this way you can sit back and watch it, et cetera. And then if you want, you email me or call me, et cetera. The sixth and final class is disposing of real estate. So you have to watch out for things like depreciation recapture, or maybe you can dispose of it and not have to worry up front about the tax ramifications. We call that a Section 1031 tax deferred exchange. Then there's involuntary conversions, and then also maybe you can make the sale utilizing the installment method of accounting. That would come in handy. So I'd like to start off by talking about chapter 2 first, chapter 2 in the book, which is called Key Principles of Real Estate Investing. All right. For instance, let's say I'm thinking about investing in a real estate entity or buying stock in a REIT, that's a real estate investment trust, or investing in on the stock market, other real estate entities that are not REITs, okay? Let's assume, more than likely, if you're a regular equity investor, you may shy away from investing in real property. Why? Because generally speaking, the bottom line, the income statement, a lot of times the income statement, the net income is very little. And so why do it? Okay. So if you know the following, you may make the decision to invest in a real estate entity. First of all, the flow through of tax benefits. I'm going to get into entities in a moment, but if you are a sole proprietor or a partnership, etc., or even an S corporation, all of these entities I'll go into, the income that comes into those entities flows to your personal income tax return. Okay, so the tax benefit of that is a lot of real estate entities have losses. They're not real losses. As I said before, concerning depreciation, you're writing off the building, and that huge expense can be taken as a deduction on your personal federal income tax return, and your states too, state and localities. So therefore, it's a wonderful thing, tax-wise. It's a wonderful thing. It's a write-off. Okay, so therefore, flow-through tax benefits would be wonderful, where you don't get those benefits, generally speaking, with other entities, like other industries or companies that are not in the real estate business. Leveraging. In the real estate industry, we call that O RPM, using or utilizing other people's money. Okay, I treat it as a principle. Where in other industries, they leverage also. They go to a bank or they float bonds, etc. But they don't have something that your company's going to have, and that is real property. Generally speaking, real property. So if you have real property, you can leverage. The loan or the mortgage can be much higher than if you have no property. Okay, because the bank, if something happens, the bank can fall back and sell the property in order to get back what you owe them. All right. So some real estate entities, they have 70% of their balance sheet is in liabilities to a bank or a lender or a lending facilitator. Okay, and basically you don't see that too much with a high tech company or a company that has no property whatsoever. You may see it with some manufacturing companies if they own their property and their machinery. So that's how they can do a little leveraging. But generally speaking, leveraging for a real estate entity is a great part of the game. You should leverage. I've had owners of companies come to me and they'll say, why should I leverage? And I understand most of the people watching this module will they have the answer, but let me bring it up just to make sure. Let's say you need $10 million in order to start a business, a real estate business. All right. So, I mean, you could put the whole $10 million in, right? So, and then you own everything. It's wonderful. Okay. But why should you do that? Why don't you go to a lender and maybe get $7 million, right? And then you just have to put in 3. So that's leveraging. That's using other people's money. And in this business, you really, really, really should do it. And then there's also non-taxable cash withdrawals. That is, you can get back some of your equity that's either part of the original capital that you contributed or that you already paid tax on. Okay, but it's not like a dividend that you get from a corporation. It is not like that because you're not going to pay tax on it. All right. There's small little things that I want to get into concerning that later on in the course, like I think the third session that we're going to have. All right. So this would be key principles of real estate investment. In the next Zoom class module, I'm going to talk about choice of entity, a sole proprietorship, a partnership, et cetera, et cetera. Okay.